Hey traders, Raghee here. Welcome to Charts and Coffee. We are taking a look at the post-PCE environment. We just got, and I'm going to give you a little bit of the notes that we did this morning from the session we did in the Mastery around the PCE, which is a futures trading session because that's what's open, right? We're going to get our bell here in 29 minutes. We had what would largely be considered a pretty positive PCE. I say positive because it favors what the Federal Reserve's narrative has been, which is that they have been communicating that the inflation is slowly, but not quickly enough, but slowly cooling off. And there's no doubt when you look at the month over month and the year over year, it's lower than previous and it's in line with forecasts. Now, I think what makes today's PCE unique and probably a little bit more convoluted is because we have end of quarter happening at the same time as well. And a lot of times end of quarter is a combination of profit taking in some of the better performing sectors and stocks, and then bargain hunting in some of the laggards. And if you take a look at that phenomena, consumer discretionary would probably be a pretty good example of something that's been lagging the strength in a lot of other tech, suddenly coming on strong this week. Amazon would be a great example of a non-trending environment with a lot of bullish momentum. Tesla would be a great example of this week going into end of quarter, a neutral non-trending environment having a lot of bullish momentum. So you can see that in some of the lagging stocks, not things that are already in uptrends and have been moving higher. Probably the greatest two examples of that for Q2 would be Nvidia and Apple, right? So I'm not going to be surprised to see a little bit more profit taking, especially in semiconductors and some tech. So the end of quarter is an event unique to itself. It's not about the technicals. It's a lot like OpEx in that OpEx doesn't care what the trends were. We're just getting this migration towards how can we render the greatest number of options worthless at the end of the session. End of quarter is a little bit more about, hey, if I'm gonna show profits to my clients, right? For example, think about money managers reshuffling a portfolio going from one quarter to the next. They want to show profits. What better way to do that than scale out of winners like Apple and Nvidia or semiconductors? And then they will also want to position themselves, which makes perfect sense. If you've got a second half of the year or another full quarter to see gains, why not buy different sectors and or stocks that could be poised for movement higher? And that's where crude oil strength has been really interesting. Crude oil strength that we've seen, again, the second half of this month, really does then beg the question, why not start to bargain hunt in oil services and in energy stocks? Not all of them look great. Most of them are still in heavy downtrends. However, again, bargain hunting is not necessarily about finding something that's strong. It's finding something that has the ability to have maybe a good quarter or two going into the second half of the year. So that's just a phenomena of end of quarter that's unique, right? We're not seeing this every day. End of quarter is the most intense. The last quarter, end of the year, is the absolute most intense. But we don't see typically this kind of sector rotation throughout the month. And even if we do, it's probably just built on news or earnings or something like that. The end of quarter really is about the way in which your longer term type hold, not your active trader, right? And I think that's where we really have to remember. When I wake up in the morning and I look at my accounts and I'm looking at my charts, I remember one thing really clearly. I am an active trader. My timeline, my life cycle of a trade is sometimes less than an hour if I'm day trading, and maybe days to possibly weeks. So when we have narratives that play out in 2026, it doesn't matter. Narratives of what if this happens in 4 months, unless we're putting on trades that we anticipate having on for 4 months, that kind of prediction, as if anybody knows, look, it's Friday morning. I don't even know what I'm having for dinner, yet someone's gonna be on television telling me where a stock is going to be at the end of the year. That's entertainment, and that's the function of financial media. But remember, targets aren't trades. The journey to the target is the trade. And if the journey for a trader, an active trader, is untenable, there's no trade there. And so when I think about sort of juxtaposing what we do with this kind of longer term approach, asset management, capital allocation, sector rotation, all those buzzwords. It's going to affect our trades. But in and of itself, it's not necessarily a trade. So a lot of folks have said, Rog, you're talking about sector rotation in semiconductors. That just means profit taking. Profit taking can just represent a pullback, a retracement of a very strong trend, which is exactly what we have in semiconductors. So if you were to talk to me now, which we are, I would look for a little bit more profit taking in some of the hotter names and sectors from the quarter, from the month. But I'm absolutely expecting those trends to resume going into July. So keep in mind, we could look at a pullback and still keep an overall bullish attitude. And by the way, here we are at the end of June. Here we are at the end of Q2. And, I can't emphasize enough. I really want to ask anyone out there on television or wherever saying sell in May and go away. Let's complete that sentence. Sell in May and go away is the dumbest thing that you can say. That's really what should be said. So there you go. I finally, after 30 years, completed that. So what is really the sell in May narrative? Sell in May and go away is the dumbest thing you can say. Trends are all that matter. And the macroeconomic expectation of the Federal Reserve cutting rates. And yes, you might say, Rog, I've heard they may not cut. Let's take a look at the data, right? Because PCE is a great time. In the wake of PCE is a great time to do it. So let's take a peek at our target rate probabilities. Now, July is not up for grabs. July is not part of the narrative at all. We're not expecting any kind of rate cut in July. So that's not it. The first month that currently we would expect a potential rate cut is September. Now you'll notice I have some numbers here. There was a 35.9% chance of a hold before the PCE. Now these are Fed Fund futures contracts. 0.9% expectation for a quarter point cut. That is now a little bit higher at 61.1. Now I'd love to see where we end today and start July, what this data and what these Fed Fund futures are telling us. But this is not in any way doing anything other than incrementally improving expectations for a September rate cut. Until it's about 80%, I'm going to say it's a possibility, but not a probability. Okay. So let's take a look then at November. November was a 24.1% expectation for a hold, and now it's only 21, right? We had a 50.7% expectation for a cut. You can see it's only 51. Well, Rob, that doesn't look so good. But now we're in the spillover effect, because if we cut in September, the column in play is the 475 to 500. And that went from 23.1% to 25.7. So you'll see, rather than increasing the probability that September is not a cut, November views September as, hey, we could get that cut in September. So there's a 25.7% expectation we get a second cut in November, right? So that's how that works. So it doesn't necessarily have to land in the quarter point column if expectations are rolling into a second quarter point cut. And that brings us to December. Now, I'm only talking about end of year. I think there's some expectation that, oh my gosh, if we don't cut by end of year, the window closes. Oh gosh, no, because I'll show you something else before we wrap up. Take a look at December. The hold expectation was 31.1. It's down at 28.4. This being a potential first cut was at 43.5. Now it's at 44.7. But what's really interesting is the spillover that we're getting into this being maybe the third cut is starting to increase a little bit. So you might say, Rog, it's not that much more expectation. Agreed, but it's not any less, right? And then take a look at January. Let's jump out to January. Let's jump into our time machines and hit fast forward. The Federal Reserve doesn't have to be done this year, right? They can keep on with that accommodative stance into 2025. And based on Fed Fund futures, it's alive and well. There's a 26.9% chance that we're a full 1 point or 100 basis points, 1 full percentage point lower. There's a 26.9% expectation of that. Now, it's more likely that we might be at 3 cuts, right, come March, which means we either get September, November, December, or we get November, December, January. But you see, the rate cuts aren't necessarily over, and they are still widely expected. Okay. And anytime we're in the mode of expecting, they don't even have to happen, right? You might say, Rog, what if they don't cut at all? We're going to have a significant pullback, but that's a big if. In the meantime, the anticipation of is keeping the equity markets fairly strong. Bonds loved the PCE. So for as much as equities seem to be kind of meh about PCE, bonds loved it. Bond yields went lower. Look at that, straight up. So we didn't see any major reaction from equities. And again, remember, we still have that end of quarter implication. So they might just say, look, no reason for us to necessarily buy into higher highs in a big way, but we have this end of quarter and there is this profit taking type psychology that's going to likely be the dominant psychology. So take a look at bonds though. I mean, is sector rotation something for bonds? Probably not. And look at what bonds are doing in the wake of PCE. Straight up, which means lower yields. Okay. So if you're wondering how we can view that, what's another way to view it? The euro. So if the US dollar weakens when rates are being cut, I should see some strength in euro. Tell you what, it's not as convincing. This is not as clean a play though, because remember, the Bank of Canada is already cutting. The Bank of England, the ECB, these central banks tend to ebb and flow very similarly. So if we're seeing cuts in the US, it's probably only a matter of time before Bank of England, European Central Bank also cut too. So this might just be a little bit of a competition of euro weakness, anticipating ECB cuts on top of US dollar weakness, anticipating FOMC. So US dollar is not going to be probably the cleanest way to view that when it's not only this US central bank thinking about lower rates. All right. But bonds are telling a pretty clear story. And that's what we've got there. All right. So as always, gang, if you have any questions, feel free to type them in and we'll go from there. And I really wanted to make sure I cover some of these macroeconomic implications with you all because they are important. When folks say, Rog, why are we moving higher? Anticipating rate cuts is never bearish, right? Now, the environment that often can precede rate cuts can be awful, right? We saw what happened in 2020. There's a reason the Federal Reserve went full on accommodative, printing money and cutting rates. So the environment can be something that's troubling, but the end result and the anticipation, right, of rate cuts is bullish to equities and bullish to bonds and typically bullish to gold and typically actually bullish to euro. So I'm going to stick with that probability. All right. Next up is, and I'm always going to come back to the data, gang. This is never about what I think. All right. This is never going to be, what I think. It's always going to be, what does the data show? And that's why we take a look at, again, that's what we're taking a look at what's happening with the overall environment. Tough not to be a bull, gang. Tough not to be a bull. What did we learn today? Sell in May and go away. It's about the dumbest thing you can say. There you go. All right. As far as AMD goes, I would wait till July, Monday. I would wait till July. If we can get a dip in SMH, I'd rather do that, my friend. AMD is actually not one of, well, let me show you here. Super important. When we're looking at relative performance and we're looking at the best examples of stocks in a particular sector, AMD is really not going to cut it. It's not been trending in the way that NVIDIA, Taiwan Semi, AVGO, ASML, MU, AMAT, LRCX, KLA-10 Core. These are far better choices than AMD. The thought about AMD would be, well, if the semiconductor as a rising tide continues higher, then maybe all the stocks would benefit. But let's do this. Let's think about it as who here's a boater, right? My boaters out there. Sure, the tide can come in and can come out, but who knows what a bilge pump is? It's the thing that spits the water that a boat takes on, right? So it's a very important component. Okay. So when you have a broken bilge pump, your boat's taking on water and you just can't get it out quick enough. And so when you think about collecting water in your hull, And even though the tide is rising, what's going to happen to that boat? That's the way I look at these things. So would I rather have a good, healthy, floating boat in that overall rising tide? Absolutely. And that's where we differentiate between ASML, AMD, ADI versus all of those other green uptrends that are tracking with the SMH, which is very strong. So I like SMH. I like semiconductors, but I would likely pass on AMD unless, again, the thought is, but Rog, I could scoop it up and make a trade. For a trader, I would say pass on AMD. But if you're thinking longer term, if you're a little bit more of a buy and hold, maybe that's something you could look at a daily or weekly time frame and say, Rob, my time horizon's far longer. I don't mind buying AMD at $1.55 and waiting for it to get to whatever my expectation is. But that's not really a trade anymore to me necessarily. So if we know our time horizon, and as most of us here, right, we're traders, we're active traders. What's going to happen a month or two from now actually isn't relevant, right? Because our time, for most of us, observing the simpler verse, as the Lorna Bot likes to call it, I love it. Observing the simpler verse, most of us have time horizons of hours to maybe days, maximum weeks. So when I'm looking at something that as a trade that could be months out, that's usually going to be a weekly time frame. And that's usually be something that I will think about a little bit more akin to a buy and hold. All right. All right. Next up is ARRM. Let's take a peek here. ARRM. I've had quite a few folks ask me about ARRM, unless it was you that asked me before. As far as this goes, yeah, buy a pullback. Buy a pullback. It is a trend. I would not buy into higher highs, but maybe even a visit back down to 156 and change. Definitely down to 150. I'd keep an eye on, but I won't buy into a higher high. TBBB. Let's take a look. We have a trend. I would pass on this right now for a long position. I would pass on this for now. If we can get back down to a range between 22.33 and 21.41, then I think maybe, but I would try to focus on names that are rising with the tide, right? S&P is strong. NASDAQ is strong. Tech, consumer discretionary, even semiconductors, communications, these are all quite strong. So I would stick with things that are strong and just anticipate them to get stronger. Find things that are participating with the strength, gang. Don't focus too much on things that aren't yet participating. If it's neutral bullish, like Uber, that's fine, right? Uber doesn't have a trend, but it's neutral bullish, right? And I can't do anything with Uber again until it gets down to about 69.10 on that one, Joe. All right. Next up is XLC, Kathleen. It really depends on the options chain. If you're looking to buy the ETF itself, the shares, fine. But oftentimes with XLC, we're just not going to see liquidity at all the different strikes that we might be considering. So you'll notice probably liquidity at the fives, 80, 85, 90, 95. But remember that Google is in an uptrend here. Netflix is in an uptrend here. EA is in an uptrend here. There's a lot of names in communications that are moving higher. T, which is a holding in the Sector Secrets Mastery right now, is in an uptrend. So I'd say find an individual stock as a proxy or an outperformer within the group of communications. All right. And then any of the trades in semis, gang, I'll look at them mostly into the close today. So I'll be with you all in the Sector Secrets Mastery and in the Simpler Central room. And I'd prefer to look at post-lunch, right? Getting to the tail end of end or quarter rotation potentially. And that's where I'd start looking for swing entries. So the window will open briefly into today's close for potential swings or into Monday. Gang, as always, thanks so much for being here for Charts and Coffee. I will see you all on Monday. Be good to each other.